Now, welcome to the look ahead video for Monday, the 11th of March. Now, it's an interesting week this week, particularly in light of last Friday's non-farm payroll. We're going to be looking at the US CPI print in particular. But before we get stuck in, let's just remind ourselves why we prepare and look at these opportunities in advance and the sort of opportunities that we can get from them when we get a high probability deviation. February the 13th, we were looking at this US CPI print, and what we're looking for is if we saw a hot print, high US inflation, that was going to push the higher for longer rate narrative out of the US, should support the dollar. Earlier in the session, we saw a miss in the CPI data out for Switzerland, so we had a Swiss franc sell bias. So if we saw a high print, dollar Swiss franc buying was what we were looking for, and on the event, we saw it came in, yes, month on month above expectations in terms of the forecast distribution. The core 3.9%, that was above the top end of forecast distributions, and the month-on-month data also towards the top end of forecast distributions. So all of that was a tradable opportunity. The only one that wasn't was the year-on-year CPI. It's at 3.1%. Would have liked to have seen that a bit higher, and if you looked at what we're looking for here, is 3.3% or higher. However, on balance, given the fact that there weren't any negative revisions, these were pre-existing, it meant that there still was a clear dollar Swiss franc buy bias, which we took out of this event in our live meeting. And you can see that we just looked for a run up in the dollar Swiss franc, took an immediate long, taking profit as price moved higher, and are looking actively for a pullback entry around this 8818 region in case we get a pullback during this session. Just a nice clear example of how looking at significant data points, preparing for them in advance, gives us high probability trading opportunities. This is one of those opportunities we took in the dollar Swiss franc in the month of February. So that's why we are looking at the calendar, because we want to see opportunities that are potentially setting up in advance. And whenever we analyze markets, we're always using the same process. We're looking to use the baseline so we can recognize what a surprise is, and then we just look at that in light of the bigger picture. So it's a very simple process. We use the same process over and over again. It applies slightly differently in different circumstances, but the principle is always the same. So this week, really nothing on Monday, but Tuesday becomes more interesting. We've got some UK data out for the UK markets, which could be very interesting for the pound. If you just take a look at the pound at the moment in the CFTC report, you can see that pound longs are stretched to the upside. So the pound has been sort of steadily bought over the last few weeks, even though we've got a weak bearish bias for the pound. The Bank of England has been very sort of resilient, and we're not going to cut interest rates until we know that the job's done in inflation. And one of the things that the Bank of England are looking carefully at is what's going on with wages. Now, wages are important because strong wages are seen as inflationary. If wages are going up, then that means they can pay higher prices in the economy, and higher wages themselves can lead to higher prices. So what the Bank of England really wants to see is weakening in the labour market, and particularly wages. And you can see average weekly earnings. Now, we'll be looking at the details nearer the time, but we want to see them moving significantly lower. And if we start to see average weekly earnings dropping significantly below what markets are expecting, that could very easily lead to some nice moves lower in the pound, and those stretched pound longs can quickly unwind. So we're going to be looking at that very carefully on Tuesday morning, followed by the CPI print on the afternoon in the UK. Now, you saw with the introductory video that we had an opportunity on this CPI print in February when it printed strongly for January's reading. This is the print in March for February, and the non-farm payrolls were quite mixed for the US last Friday. You can see on balance they were weaker because the headline surprised the upside, yes, but the prior was revised lower. And remember that stunning prior of 353,000 jobs? Well, that was revised down to 229. So there was, something a little bit up with the January reading. That's what markets were suspecting. And then look, unemployment coming in above all the economists were surprised at the upside. looking at our forecast distribution, you can see how markets were positioned. And in terms of the unemployment rate, look, none of the analysts surveyed are expecting it to be as high as 3.9%. So that was a big surprise. That's dollar negative, and average earnings revised lower on the print. So this was dollar positive, that was dollar negative, dollar positive, dollar negative, dollar negative, dollar negative, dollar negative, dollar negative, dollar negative. And that weakened the dollar initially out of the non-farm payrolls. So if we see another big miss, if we see a big miss in the CPI print, then we expect some of that dollar selling to continue. And then maybe markets will start pricing in more than 3 rate cuts this year. Perhaps we'll start to see that some of that dollar weakness accelerate even further. So this will be something to look at. Alternatively, if we see a hot print and inflation is problematic, then we can see some of the recent weakness unwind, and gold would be very vulnerable to falls, particularly if you've got yields pushing back up, dollar pushing back up. That should send gold significantly lower if we've got a hot print here. So that's one definitely to keep an eye on. Then we've got GDP data coming in for the UK. If we start to see a big decline in the UK GDP, then likely that will put pressure on the Bank of England to cut interest rates more quickly. And dovish board members of the Monetary Policy Committee, like Dhingra, will start to have more of a voice. So a big dip in the GDP, then you can start to look for continued weakness. The US inflation rate, you can see it's still above the Fed's 2% target, but it is continuing to move in the right direction. So it'll be very interesting to see what the next print is. And GDP annual growth it's just flat lining here in the UK. So again, something that surprises the downside, that will increase expectations of the Bank of England cutting interest rates, and some of those stretched pound long positions we could see unwind. Then as we go through the week, there's not a whole lot. The PPI print possibly could be something, but we need to see what the CPI print is first. Retail sales for the US, be interesting to see how the US economy is doing, and in terms of the retail sector. Looking for the Friday, the University of Michigan said, now this is helpful because it's early data, it's data for March. And we did see a bit of a drop in the Michigan Consumer Sentiment revision for February. And if we see a sharp drop in March, then that will again accelerate a little bit of dollar selling, and also we'll be looking at the inflation expectations out of there. So I think the University Michigan Consumer Sentiment print could also be worth looking at. We'll look at the detail nearer the time once the calendar is fully populated and we know exactly what the low and the high forecasts are. But looking forward, they're the events. The main event of the week is really that US CPI print on Tuesday. But there are some potentially good opportunities out of the UK on Wednesday and Tuesday morning, particularly wages. They're a major focus for the Bank of England, and an out of consensus print, particularly an out of consensus print lower, should really move the pound lower as well. So that's what we'll be looking at, and look forward to this week, and hopefully we'll get some good trading opportunities out of this lot.